Dear learner, welcome to the lesson today under the Manifested Publishers Learning Platform. And we are continuing with our human resource management subject. And we are looking at the lesson on reward management. And in reward management, we have an area on salary administration policy, which we are going to look at today. And when you look at a salary administration policy, it is a guideline that is used to determine, implement, and review salary levels and structures in an organization. So this is very critical because payment of salaries and rewards to workers need some format or some arrangement where decisions which are being made are made consistently in a transparent manner and can be verified. So a salary administration policy provides that guideline to be able to assist in the determination, implementation, and review of salary levels and structures in a structured way in a given entity. So in our lesson today, we are going to look at the importance of a salary administration policy. We will also look at components of a salary administration policy and the structure of a salary administration policy. So we will start with the importance of a salary administration policy. Importance of a salary administration policy. Salary administration policy. So why is we have seen that a salary administration policy is a guideline, and this guideline provides a direction in relation to determination, implementation, review, and looking at the levels of salaries in a given work environment. So when it comes to the importance, one of the reasons why a salary administration policy is important is to eliminate, so one, elimination of perceived salary inequalities. Elimination of perceived salary inequalities. Oftentimes, learner, workers have a feeling that maybe they are not being paid commensurate to their efforts. So when you have a guideline, then this guideline will eliminate this perception, and workers can be able to see what is their grade, where are they in the structure, how do they progress. So this becomes a guideline that can help in the elimination of the perception of salary inequalities among staff. Then secondly, it helps in the attraction, of talented workers. So when an organization has a structured salary arrangement or a policy, then prospective employees are able to look at this kind of a guideline, and if they have the wish to join that organization, this can be one of the reasons why those kind of employees can be attracted to that given work environment, so that they can be part of that kind of a workforce. Then number three, assists in the retention of employees in an organization. So employees who have their salaries determined, their salaries reviewed on the basis of a given policy or a given guideline, where individuals don't have to use their own maybe discretion, then such employees can be retained in a given organization to be able to perform their engagement levels are higher among staff. Organization that has a salary administration policy which guides in terms of, say, promotion, maybe lateral transfer, benefits and so on. Those kind of employees will be engaged more in terms of their work because they know other issues like, for example, reward management are assorted by this particular salary administration policy. So the engagement levels of staff are likely to be high. Then there is also the element of compliance. When it comes to, for example, statutory returns, they are made in accordance with the salary administration policy within that particular work environment. So that compliance, again, is one of the reasons why having a salary administration policy is important. Then there is the element of financial management assists in financial management, especially with labor-related costs. So salary administration policy will assist in the financial management, and in many organizations the costs of payroll could take as much as, say, 45% of the organizational expenses. So you can see this can be quite high, and when you have a proper salary administration policy, it becomes very clear. Then number 7 helps the organization better negotiate with trade unions. So where an organization has a proper system in relation to administration of salary, then they are able to at least discuss with the union officials, discuss with trade unions, and be able to come to an understanding in relation to how reviews are supposed to be done. If there are any disputes and so on, they are able to negotiate based on the policy within a given organization. So those are some of the reasons why it is important. Components of a salary administration policy. Components of a salary administration. So what are some of the aspects you expect to get, some of the contents you expect to see on a salary administration policy? So when it comes to a salary administration policy, some of the things that may be handled here may include: 1, basic pay; 2, traveling allowance. Then you have 4, overtime pay. Then you have 5, leave allowance, tuition assistance. So some organizations, Lana, have a tuition assistance option where if workers are taking up some course, those workers could be assisted by the management to be able to pay for that particular tuition. And in some cases, there are also some generous employers who are basically able to assist the spouse and maybe the children of the employee. So those could be some of the things that are captured in terms of components of a salary administration policy. Then you have 7, promotion. Then you have 8, transfer. Then you have 9, pension. Then you have 10, deductions. So these deductions could, or cooperative, or other checkoffs and so on. So these could be some of the things you expect to get on maybe a payroll. Is there one specific kind of a structure? The answer is no. Organizations may have different policies structured in certain ways, but some of the information that may be cross-cutting is what we want to have a look at, so that if you have a structure of a salary administration policy, or if you go to an organization, dear learner, or you work for an organization and you have now been told, prepare a salary administration policy, So what are some of the things that may be on that particular policy that you may want to include? So one, the name of the organization. So one can be a logo. Policy will be administered by the Human Resource Department or Human Resource Section. So administration of the policy has to be indicated so that if there are questions, those questions are directed to that particular department or section. Then description of the jobs covered. Here could be human resource jobs, marketing jobs, and so on. So the description could be included. Then number 6, grades or scales for jobs. That should also be indicated. And then there are those particular specific items now that will be covered in relation to that particular policy. For example, the administrator of this policy is HR. On that month when an employee is transferred, if their salary is 35,000, then for that month they multiply that by 2 and pay that employee 70,000, and they refer to the policy that the policy provides. If an employee is being transferred, the salary is paid double and so on. Then there are also issues of number 10, acting in position. So if an employee acts in a position for a given duration of time, so when that employee is acting and they are also performing their own work, for example, so what happens? That must be provided for in terms of the salary and so on. Then number 11, there is the issue of maybe incentives and bonus. So if incentives are supposed to be provided, this particular structure policy, this particular leave of absence, so when an employee is on leave of absence, what happens? Do they get paid? If they are on annual leave, what happens? Do they get a leave allowance, or do they get their full maybe gross salary and so on? So this could be some of the things that could be found on a salary, on the structure of a salary and administration policy. And in addition to this, the structure of a salary determine, implement, and review salary levels and structures in an organization. And we indicated that we would look at 3 areas, which is importance of a salary administration policy, components of a salary administration policy, structure of a salary administration policy. And under importance of a salary administration policy, we have said, number 1, it helps in the elimination of perception of salary inequalities. Number 2, helps in the attraction of talented workers. Number 3, assists in the retention of employees in an organization. Number 4, enhances engagement levels of employees. Number 5, assists in legal compliance, for example, minimum wage or salary. Number 6, assists in financial. Number 7, helps the organization to better negotiate within policy. So how can it be structured? Then we said, number 1, it needs to have the name of an organization and, if possible, the logo, the title of the policy, which captures the specifics of that particular organization, the scope of the policy, number 2, number 3, number 4, administration of the policy, where is it hosted, number 5, description of the jobs that are covered, number 6, grades or scales for jobs, number 7, entry into jobs or grades, number 8, promotion progression, number 9, transfer, number 10, acting in position. So if an employee is acting in a given position, what should be the payment like? Number 11, incentives and bonus. Number 12, basic pay. 13, pension and benefits. 14, retirement. 15, leave, which may, for example, be annual leave. That an organization that formulates and implements a salary administration policy. So learner, this is your assignment. Discuss the benefits that may be enjoyed by an organization that formulates and implements a salary administration policy. So that's your assignment that you need to work on to be able to entrench the knowledge that we have gotten today, and also enhance your skill in the area of salary administration in our topic that we have looked at today, which is human resource management, and in the practice of human resource management. So thank you.
Number two, we have ratio analysis. So when talk about the ratio analysis, as the name suggests, analyzing the financial statements, and it involves computation of ratios. Or this tool entails computation of what we refer to as the financial ratios. What is a financial ratio? This is basically a relationship between two or more financial variables. For example, in this case, as a financial analyst, you can express the profit reported by the company, or maybe the net profit or the operating profit as a percent may be computed using the information in the income statement and the statement of financial position. We have the profitability ratios, liquidity ratios, efficiency or activity ratios. We also have the solvency or capital structure ratios, and the investment ratio. So therefore, what we are going to do here, we are going to look on what is the uses of those 5 categories of ratios. So let's start by looking on the uses of the profitability ratios. Now, these particular ratios here are used in terms of measuring the performance of the company's management, because in this case we say that if the company is performing well, then that is as a result of the good performance of what the company's management. So therefore, these ratios we can say they measures a performance of company's management. If a company is performing well, we have said that will be as a result of the good performance of the management. If the company is not is performing poorly, that we can also say it is as a result of the performance of a company's management. Then we also have the other category of ratios, and that is the liquidity ratios. So how do we use these particular ratios, or how are these particular ratios used? Liquidity ratios, these are ratios which are computed. We're going to look on various types of liquidity ratios, and they are used to So number 3, we have the efficiency stroke activity ratios. And these ratios, on the other hand, are computed to determine how well or how efficient the company is using its assets or its resources to generate revenue, or basically to generate profit. So we can say the measures the efficiency basically efficiency, we are talking of how well the efficiency stroke capital structure ratios. Now these ratios, on the other hand, are computed to determine the ability of the company to pay or to settle the long-term debts as and when they fall due. They measure the ability of a company, to meet long-term financial obligations. Long-term financial obligations. So these ratios are computed to determine whether the limitations of ratios. And basically here we have various shortcomings. We have various limitations associated with the ratios. Number one, we say that ratios are historical in nature. Ratios are historical in nature. Historical in nature. So historical in nature means what? It means that when a financial analyst is computing ratios, ratios are always computed based on the past data. And therefore, if the circumstances have changed, then those particular ratios cannot be used in terms of making what? Decisions about the future. That is one of the limitations. Number two, we say ratios ignores the time value of money. Ignores time value of money. 3 years what? Back. So the ratios here totally ignore the time value of what? Of money. On the other hand, we say ratios also ignores inflation. Also ignores what? Inflation. Ratios do not have any consideration as far as the changes in the prices of goods and services is concerned. Number four is that ratios ignores a qualitative aspect. Ratios ignores the qualitative aspect. So basically what that means is that the information which is provided after computing the ratios is purely quantitative. Ratios provide information about profitability, and that is profitability, liquidity, and efficiency. Different what? Entities. So therefore, these are basically some of the limitations facing what? Financial statement. These are very, very common question, particularly in this paper called FRA. So therefore, you have to recall those particular limitations of what? Of ratios. So next, I want us to look on the various categories of ratios which are computed, and actually the ratios which are computed under each of the category. So we start with the profitability ratios. So these are categories. Say that is equally due to what? To the poor performance of the management team. So which are some of the profitability ratios which may be computed? So we can say these include, these ratios include So, and what is important as far as these particular ratios are concerned is to recall, to remember the formula, because without remembering the formula, then you can't be able to tackle any question on ratios. So we have the first ratio here, or the first profitability ratio, which is known as the return on capital employed. Return on capital employed, abbreviated as ROCE. So how do we compute this? This one is computed by taking net income, or basically the profit after tax, and then we divide that with equity times 100. So equity, you have to recall, this is ordinary share capital and what? Ordinary share capital plus reserves. Ordinary share capital plus reserves. We have the other profitability ratio, which is net profit margin. Net profit margin. And the net profit margin equally, because we have the word margin, our denominator here will be revenue, and then net profit. So the net, which is also known as net income, times what? Times 100. So therefore, these are some of the profitability ratios which may be computed by the company purely to evaluate how the company is performing. And you have said that the company performance will be directly related to the performance of the company's what? Management. So let's move and look on the other category of ratios. These are ratios which are computed to do what? To evaluate the ability of the company to meet the short-term financial obligations as and when they fall due. So majorly here we have like 3 liquidity ratios. The first one is the current ratio, which is also very, very common in the questions in this paper. So current ratio is computed by taking the current assets all over current liabilities. And in this case, it is important to mention here that a recommended, or in other terms, we talk of ideal current ratio should be 2:1. So for the company to be in a position to pay the short-term financial obligations as and when they fall due, the current liabilities must be 2 times of the current what? The current asset must be 2 times of the current liabilities. So then from there we have the quick ratio, which is also known as the acid test ratio. So this is a ratio which is computed to determine the ability of the company to pay the short-term debt as and when they fall due using the highly liquid current asset. And basically all the current assets of the company are highly liquid except the inventory. So therefore, to compute the quick or the acid test ratio, we take the current assets minus the inventory. We say inventory is not highly liquid. It cannot be converted into cash within a short period of time. If you have a business and you have some inventory which is lying there in your business, there is no way you'll keep on calling your customers maybe to come and buy the inventory which is there. Inventory is not highly liquid. So we take current asset minus inventory divided by current liabilities. And then finally we have the cash ratio, which is basically a ratio which is computed to determine the ability of the company to pay the short-term financial obligations using cash and cash equivalent. So therefore, in terms of how we compute this, we take cash plus cash equivalents, or basically we can say cash and cash equivalents. Cash and cash equivalents, then divide that with the current liabilities. So when talk about cash here, we are talking of cash in hand, cash at bank, and then cash equivalent. These are short-term investment. Short-term investment, or those particular investment by the company, and which in the statement of financial position are part of the current asset. So therefore, you have those as the various liquidity ratios. Let's move and look on the other category of ratios, number 3, and that is efficiency stroke activity ratios. And I think we have already said that these are ratios which are computed to determine how efficient, how well the company is using now its assets to generate profit. So in this case, we have a number of efficiency, or a number of activity ratios, which include the inventory turnover ratio. This one is computed by taking what? By taking the cost of sales. I mean, the number of days the company takes to make sales. So in terms of how we compute this, we take the average inventory, then we divide all that with the cost of sales times the number of days in a year. Usually you'll be told to use 365 days. So the other efficiency or activity ratio, number 3, is the trade receivables turnover. And on the other hand, this is a ratio computed to basically determine the frequency of debtors paying their debts, or in other terms, is a ratio which is computed to determine on average the number of times the debtors paid their debt. The higher the number of times, the better. So how do we compute this? The trade receivables turnover in days. In other terms, this particular ratio can also be known as the trade receivables correction period. It is a ratio which is computed to determine on average the number of days the customers take for them to pay their debts. The shorter the number of days, the better. So how do we compute this ratio? We take the average trade receivables, we divide that with the credit sales times 365 days. Then the other issue, number 5, we have trade payables, turnover. And on the other hand, this is a ratio now which is computed to do what? To measure the frequency of paying the suppliers, or the number of times on average the company paid the suppliers. So in terms of how we compute this, we take what? We take the credit purchases, or the cost of sales. In most of the questions, the examiner will not have given you the credit purchases. So instead, we use what? The cost of sales, and then divide that with the average trade payables. And anytime you see average, to compute the average, you take the opening balance plus the closing, divided that with 2. And then we also have the other efficiency or activity ratio, which is trade payables turnover in days. In other terms, this can also be known as the trade payables total assets turnover, still an efficiency ratio, and this is computed by taking revenue. Remember, revenue is the same with the sales. We divide that with the total assets. So those are the various efficiency or activity ratios which may be computed by a company to evaluate how well the company is using its assets to generate a profit. So let's move and look on the other category of ratios, which is number 4. Number 4, we can look on the capital structure. The capital structure stroke solvency stroke leverage ratios. And we said that these are ratios computed all the finance cost for the year, the interest or finance cost for what? For the year. Let's look on the other ratio, number 3. Number 3, we have financial leverage ratio. This one is computed by taking the total assets, and then we divide that with equity. Equity, always we have to recall that is the share capital plus reserves. And then number 4, we have the debt ratio. Debt ratio, this one is equal to total liabilities all over total assets. So I've said these investment or equity ratios, which include number 1, the earnings per share. Earnings per share, this is equal to the profit attributable to ordinary shareholders. This one is abbreviated as PATOS, which is profit attributable to ordinary shareholders. We divide that with the number of ordinary dividends per share, DPS. This one is equal to total dividends paid. We divide that with what? Number of ordinary shares. So this is a ratio which is computed to determine the dividends paid per share. Dividends paid per what? Per share. So that is the other investment or equity ratio. The other one is called the dividend cover. So this ratio here is computed using the earnings per share and also the DEPS. So we take the earnings per share
Hello learner, welcome to Manifested e-learning platform. My name is FAM Lingwiri, and today, ladies and gentlemen, we are discussing about the financial modeling and data analytics paper, December 2023 sitting. The focus is on question 23, and you are presented with the following information right on the left of your screen here. You've been given the stock name, Z-Term Kenya Limited, Kilimo Bora Nairobi All Share Index, and you've been given the ticker symbol right over here. You've also been provided with the portfolio compositions, and all of these total to 100%. And how you can be able to just quickly check is by scrolling down over here, and you can see that the sum is 100% right here. You are presented with the weekly returns for all of those companies, or all of those 4 companies, including the Nairobi All Share Index. Now, you are required to calculate the weekly returns for each of the individual stocks and the Nairobi All Share Index, calculate the wage portfolio, the average portfolio return for the historical period. You're told to calculate the standard deviation for each of the individual stocks and the Nairobi All Share Index. Then you're told to calculate the standard deviation for the portfolio returns to assess its risk, and to calculate the beta each individual stock of the portfolio, which measures its sensitivity to the market movements. And you can see these are 20 marks. This is 20 marks question. So the way I've decided to arrange the information is to arrange it as you can see on the right of your screen over here, to calculate the weekly returns for each of the individual stocks of the Nairobi All Share Index. So we just pick average, not average A. You can see the average right over here, and the average of what? We want to pick the average for Z-Term Kenya, to pick the average values right here. Up to there, close the brackets, then you enter. So we're saying that the average return should be negative 0.2%. Let's put it to maybe say 2 decimal places. That 2 decimal places is up to there. And if we were to drag it moving towards the right, we wouldn't be wrong, because we're saying that it picks the average for car assemblers. You can see car assemblers, it picks it right there. So that's what they're saying, the average, the weekly returns is given to us right there. Escape. We move ahead and answer part B of the question. You're told to calculate the average portfolio return over the historical period. We have been given the portfolio composition, and the portfolio composition can be linked with this top part right here. The portfolio composition is there. Enter. And we link it with all of them towards the right, Control R, like that, so that you can be able to pick the portfolio composition. Remember, we have computed the average weekly returns above here. So we just link it with up above there, and then we drag it, Control R, like that, the same values, excluding the All Share Index. Because this, all of these portfolio composition total to 100%, as you can see down here, we cannot be able to include the All Share Index into our portfolio. How do we get the average portfolio return? Pick plus, we open the brackets, that value times the average weekly return plus that value times that value, close the bracket, the portfolio composition multiplied by the average weekly return, close the bracket, and then we add finally the portfolio composition for Kilimo Bora, and we multiply that with the average weekly returns, like that. Oops, that, close the brackets, and we enter. So I think I didn't put I didn't open a bracket here, that's why it's giving me those values there. So we open a bracket over here, and then once we close it like that and we decide to enter, it will actually be okay. So we only want it into the 2 decimal places, so we just sort of reduce it like so to 2 decimal places, like that, 0.35%. Now once we've gotten our portfolio return as 0.35%, we can move on to part C. Calculate the standard deviation for each of the individual stocks and the Nairobi All Share Index. That's 4 marks. So average standard deviation would be, we pick STD stud dev, not P, because we're not picking for the entire population. We want stud dev, standard deviation for the sample. So we double click that, and we can be able to just pick the value for these values here. We highlight this value for Z term. So we highlight it down like that, and it picks to calculate for us the standard deviation for Z term. And we move up over here like this, we can be able to see we already have that given to us there. And if we were to drag it moving towards the right like so, up till All Share Index, it will actually pick the standard deviation. Remember, for example, this one is picking the standard deviation of the sample for the index, for the Nairobi All Share Index right here. Part D, we asked to calculate the standard deviation of the portfolio returns to assess the risk. And we're saying for us to be able to do that, we will need to consider the weights. And the weights would mean that we've already have the standard deviation over here compared to us over here, but now we need to factor in the weights. And we're saying it's going to be, we pick that standard deviation times its corresponding weight over here. The corresponding weights were given to us over here. We can use that, or we can even use this portfolio composition right over here. So we close the bracket and we open another one over here so that it can actually pick the values as the way we want them. Then we add the standard deviation over here. I forgot to open the brackets, so we open it right above over here. You can see it on the formula bar here. So we open the brackets there, and then we multiply that with car assemblers, corresponding portfolio composition weight. We open the brackets, we pick Ujenzi Bora standard deviation, weekly standard deviation, times the Ujenzi cement over here. Then we close the brackets, plus we pick this value here and we multiply that against that value there. Open the brackets and we close the brackets like that, and we just click enter. So we can be able to put it in for individual stock in the portfolio, which measures its sensitivity to market movements. The beta is given by covariance of the market and stock, so you can put it like so, covariance of the market and the stock. Then we divide that against the variance of the market, like that. And that's what we're saying we're going to do. Covariance of the market and stock, or covariance of the market. So we pick covar S, because we're looking at a sample, covariance, and we open it up right over here. Covariance of what? Covariance of the market. This is the market over here, so we highlight that part. Covariance of the market, and on the second array here we put the stock itself over here, bearing in mind like that, covariance of the market and stock like that, and you can see what we've done, covariance of the market and stock. So we can lock the one for the market. So we are saying this one for G is one that you can be able to decide to lock. F4 and F4. Why are we locking it? Because we want to ensure that the covariance of the market remains like that. And then we do what? We divide now, divide by, you can see the variance like this. We divide against variance, or we just put it like that, variance of the market. But now, before we do the variance like that, we can say okay like that, because that's just the covariance like that, because you can see from the formula by just the covariance. Then we continue and say divided by the variance, not var p but var s, sample, variance of the market, based by this variance of the market. So we pick the variance of these values here and we lock it. So press F4 like that and we close the brackets. That's our beta, 0.0932. And if you were to drag it moving towards the right, let's just confirm. Covariance, remember we have locked, that's the purpose of locking. This one, covariance of the market. Look, this one has moved from initially Z term to now car assemblies. You can check the previous one over here, escape, check the previous one, you see it is now currently at Z term over Z term here. Now we move on to the second one, it actually picks, but it remains, this one remains, the variance of the market remains, the covariance of the market remains. So we can be able to say that the model is foolproof. Control R. But let's see if we're actually doing this the correct thing. We want to try and prove if we were to pull it towards the right, if you're going to get a beta of 1. You can see we already have beta of 1. Beta of the market is always 1, because it's covariance of the market. It's covariance of the market against the market divided by variance of the market. We always have that value being 1 there. And so with that, ladies and gentlemen, we have come to the end of question 23. Thank you for being with Manifested Publishers. We always here for you. Be blessed.
Hi there, my student. Welcome to Manifested Online classes. My name is Joseph Kemani. So in this session, I want us to look on illustration question on preparation or presentation of a statement of cash flows. And I want us to go through that particular question, and then we see what was required. So the question reads, Lilongwe Limited is a public listed company. Details of the company statement of financial position as at 31st of March 2022 and 31st of March 2023 are shown below, together with other relevant information. So we have the statement of financial position as at 31st of March 2023 and 31st of March 2022. So we have non-current assets, which include property, plant and equipment, intangible assets, and then other current asset we have inventory, trade receivables, interest receivable, short-term deposits, and then we have bank. Other share capital and reserves we have ordinary share capital, and then reserves include share premium, revaluation reserve, and then we have retained earnings. Then we have the total equity. We have non-current liabilities, which include 12% raw notes, 8% variable rates loan notes, and then we have deferred tax. Other current liabilities we have trade payables, bank overdraft, and then we have what? Taxation. And then we have some additional information, number 1, 2, 3, 4, 5. And then what are we required in our question here? We are required to prepare a statement of cash flows for Rilongwe Limited for the year which ended 31st of March 2023 in line with International Accounting Standard number 7, which governs the presentation of the statement of what? Cash flow. Now, first of all, if you check on this particular question here, the examiner had not specified which method you should use in preparing that particular statement of what? Cash flows. But generally, anytime you come across a question for cash flows and you are given the income statement, you are given the statement of financial position, always use the indirect what? Method unless otherwise what? Required on unless otherwise what? Stated. So therefore, in this case, we are going to prepare now our statement of cash flows using what? Using the indirect method. But before we do that, I want us to go through the additional information and basically we see whether there are some workings which are required as far as that particular question is concerned. So let's go through the additional information. We see what you are told. Number one, you are told details of property, plant and equipment as at 31st of March 2023. Basically, that is the end of the current financial year. And therefore, those are the closing balances. And then 31st of March 2022. 31st March of 2022 is basically the end of the previous year, in which case those balances at the end of the previous year will be the opening balances in the current what? Year. So we are given 3 items for each year: the cost stroke valuation, the depreciation, the carrying amount. And then we are given that for added buildings and plant and what? And plant. So basically what that means is that the property, plant and equipment, which is in our statement of financial position, comprised of 2 assets: landed buildings, plant, and then we are given their what? Their cost, the accumulated depreciation, the net book value, both at the start and also at the end. So no working which is required at this point, but we may be required to come back to that note. Let's move to note number 2. We are told the company revalued the carrying value of land and buildings by an increase of 70 million on 1st of April 2022. So 1st April 2022 is automatically the start of the current year, because the current year ended 31st of March 2023. That year started on 1st of what? April. And therefore, you're told land and buildings were revalued upward, and there was a revaluation gain of what? 70 million. And then you're told in the other sentence, on 31st of March 2023, that is now at the end of the year, the company transferred shillings 3 million from revaluation reserve to the retained earnings relating to depreciation on revaluation of buildings. Equally, no working which is required as far as that point is concerned. In note number 3, we are told during the year the company acquired a new plant at a cost of shilling 60 million and sold some old plant for shillings 15 million, incurring a loss of 12 million. So in that point, we are given 2 transactions. One, there was a new plant which was acquired, and you have now to remember any activity relating to acquisition and disposal of asset, this is an investing activity. So therefore, in preparing our statement of cash flow, this plant which was acquired will be one of the items you are going to take into account in computing the cash flow from investing activities. Also in the same note, we are told there were some old plant which were disposed. Remember, what you have said is that once the company sells an item of PP, you have to prepare what? The disposal account. And in this case, as per the information which is given there, we are given the sales proceeds, because you are told that old plant was sold for 15 million. That is the sales proceeds. And also now we have what? We have the loss on disposal, which is how much? 12 million. Anytime you see the examiner having given you the gain or the loss on disposal, then there is an item which the examiner may not have given you. So therefore, I think we can start by preparing that particular account there, which is the disposal account. Disposal account. Disposal account. So remember, I've said that in preparing this account, on this side we record the cost of the asset which was disposed. On the credit side, we record the accumulated depreciation and the sales what? The sales proceeds. And then the balancing figure in this account we have said will be a gain or a loss. But in that point, we are told that this item was disposed at a loss. So we already given the loss, and the loss in our case is how much? Is 12 million. So, and all our figures are in million of shillings. So for us to be consistent, we are going to work with all our figures in million of shillings. And then which other item are we given here? We are given the sales proceeds. We are told it was disposed at an amount of what? 15. So if you check on the information which is given there, we are not given the accumulated depreciation. Equally, we are not given what? The cost of that particular what? Item. So, but we will see how to determine those particular what? Values there. Okay, before we go to note number 4 there, and also note 5, 6, there are a number of accounts maybe we can prepare here relating now to the PP. Relating to what? To the PP. For example, from the information we have in note number 1, we can open a number of accounts there at the start of the other is in note number 1. So what is the cost of the plant at the start? The cost stroke valuation. Remember, I've said what you're given as the balances on 31st of March 2022. These are opening balances. 31st March 2023, these are the closing what? Balances. So the cost stroke valuation of a plant at the start of the year is 445. What about at the end of the year? The end of the year is 440. Is 4 what? 40. That is balance carried down. Balance carried down, which is 440. Then we record the accumulated depreciation both at the start and at the end. Now the accumulated depreciation, these accounts do have a credit balance because this is a provision account. So what is the accumulated depreciation on plant at the start of the year? At the start, they were revalued at the start. It is important to note that once the assets have been revalued at the start of the year, then the depreciation for the current year will be computed based on the revalued amount, based on the revalued what? Amount. And therefore what we do is that we ignore the previous accumulated depreciations. We ignore the previous accumulated what? Depreciations. For example, in note number 1, I hope you can see the depreciation which are given there for landed buildings for the current year, that is 31st of March 2023. Now that amount of 12 depreciation for landed buildings, that is the depreciation for the current year, because I've said that that depreciation was computed based on the revalued amount. Once the assets have been revalued, the depreciation for current year we computed based on the revalued amount, and the previous accumulated depreciation are ignored. That's why we are not preparing the accumulated depreciation account on land and what? A building, simply because I've said that the depreciation for the current year for land and buildings was computed based on the revalued amount. In fact, I've said that amount which we have there for the current year, the depreciation on landed buildings for the current year, the amount of 12 million is the depreciation for the current year. So what we need to do then, can we go to note number 2? Note number 2, we are told landed buildings were revalued upward with an amount of 70. Generally, remember what you have said is that in preparing any asset account, there are a number of items you should record here. Like in this case, you have said any revaluation gain recorded on this side, and any disposal of asset, and take into account this account we are preparing it at cost. We are going to have now the asset which were disposed at cost. At what? Cost. And take into account also this account is at cost. Depreciation is not recorded here, but it should be on this account here. So the depreciation for the current financial year for plant should be the balancing figure there. I don't think we have that figure. That is one of the items definitely we need to compute. Then on this account we should have any revaluation gain, and basically we know that during the current year landed buildings were revalued upward with an amount of how much? 70. And then what we should have on this side is any disposal. Any what? Disposal. Well, there are some items of landed buildings which were disposed. Are we given such? I don't think so. I don't think we have such disposal. I don't think we have any disposal on land and what? Land and buildings. So, but we have a revaluation gain of what? Of 70. Yes. So that's what we have in note number 2. But also in note number 3, we have this new plant which was acquired. So A new plant which is acquired. Remember, for plant and equipment, okay, for plant there was no any revaluation gain, but you are given the acquisition. The acquisition is an amount of how much? The new plant acquired had a cost of how much? Had a cost of 60. I think that's what you're given in note number 2. So as far as that plant which was disposed is concerned, you can see we are only given the sales proceed and also what? The loss on disposal. The loss on what? The loss on disposal. The loss on disposal. Yes. So that I think what we have. So what we need to do now, I think we can start by balancing these two accounts here. These two accounts. So of which you can see what we don't have here is now this disposal. And basically this disposal is what we are going to record here. This is a cost of this item which was disposed and which are not given there. So therefore, can we do that? What we have on the debit side is 445 plus 60. That will give us 505 minus what we have on the credit side, that is 440. So that will give us 65. So basically it means that what? 65. And automatically, then we can get the balancing figure here, which represent the accumulated depreciation of that item which was disposed. So we take 65 minus what we have on the credit side, 15 and 12. So that will give us 38. So this is the accumulated depreciation of the plant which was disposed. Now this particular accumulated depreciation, the figure of 38, then we should bring it to this account because this is part of this opening balance and that plant was disposed. So we have the accumulated depreciation for the item of plant which was disposed. How much is that? Is 38. Then we balance this account. The balancing figure here represent the depreciation for the current financial year and which was taken to the income what statement. What we have on the debit side is 148 plus 38 minus what we have on the credit 105. So which will give us 81. So this 81 now represent the depreciation for the current year. Represent the depreciation for the current what? Yes. We also need to balance this account and basically the balancing figure in this account will be the acquisitions. Because in our case here we don't have any disposal. Anytime there are some items of PP which were disposed, you must be given that particular information. So in our case we don't have any disposal. And then because you are preparing this particular account also at cost, we don't which were acquired during the current year. So I think we are through with that additional information number 1, number 2, and also number 3. So let's move to note number 4. Note number 4, you are given the statement of profit or loss. I don't think we have any working which is required as far as that is concerned. There was an operating loss, interest receivable, finance cost, loss before tax, income tax, repayment claim, and then we have the deferred tax charge, and then we are told we are given the loss for the period, and then you are told the finance cost. The finance cost is which we have in the income statement up there, the figure of 24. It included the interest expense and also the penalty on early redemption. So this penalty on early redemption is basically a penalty which was which the company paid to the bondholders for redeeming the loan notes early. So basically this is an operating expense. And then number 5, we are told the short-term deposits are deemed to be cash equivalents. And then number 5, we are told the dividends paid by the company amounted to what? 25 million. So I think no workings which are required. And I think now with that, we can go straight to what is required. We prepare our statement of what? Cash flow. So we need to have the title here. The name of the company is Rilongwe Limited. And this is a statement of cash flows, statement of cash flows, which is for the year, which ended 31st of March 2023. Remember, in this case here, the examiner had not specified which method to use, but I've said once you're given the income statement and also the statement of financial position, then always use the indirect method. Use the indirect method So here we start by determining the cash flows from operating activities. From operating activities, we need to have two columns, and our figures are in million of shillings. Our figures are in millions of what? Of shillings. So what do we start with here? I said we start with a profit before tax. But if you check on what you're given in the income statement of this company, in the additional information number 4, we are not given the profit before tax, but we have the loss before tax. That's what we start with here. The loss before what? Before tax. Before tax, how much is that? Is a figure of 44. And because it's a loss, we record it there as a negative. We record it there as a negative, and then we make a number of adjustments to this particular what? To this particular loss. And the first adjustment, recall what we said when we were looking on the format. We say the first adjustment you make to this particular profit or loss is the finance cost, because essentially I said you should start with the profit before interest and tax, or the loss before interest and tax. But because you will not be given that, start with what you're given, that is the profit or the loss before tax. The first item we need to adjust to our profit there is the finance cost or interest. The reason why we do that is for us now to have the profit before interest and tax. Now that is given in note number 4. In note number 4, just before, above the loss before tax, we have the finance cost, which is 24. Which is 24. We add it back to that, so that now we have the loss before interest and tax. And then we have said to this particular profit here, when using the indirect method, basically there are a number of items we adjust to that profit, and I gave you a certain acronym which you can use in terms of remembering those items. Dial G, you check for depreciation, any impairment, loss on goodwill, any amortization on intangible assets, any loss on disposal, and the gain on disposal. And I think in our case we have a number of items. So first of all, we have the depreciation. So for the depreciation, we have the depreciation for what? For plant. For plant. And basically that is what we have determined here. We have depreciation, the depreciation on plant. How much is that? Is a figure of 81, because that was deducted in arriving at that particular profit. Add it back. And then the depreciation on land and buildings. So this is in note number 1. That depreciation for the current financial year for added building, that is a figure for 12. I've said that is a depreciation for the current year. Take into account our ad and buildings were revalued at the start. So meaning that the depreciation for the current year was computed based on the revalued amount. How much is that? 12. We add it back to that because it was deducted and is a non-cash item. So we have captured this depreciation on a plant. We have also taken into account depreciation of what? Land and building. So we don't have any other depreciation. So what else do we have here? We also have the loss on disposal. This one. So we have the loss on disposal. And this is the loss on disposal of plant. Still an amount of 12. That was deducted in arriving at our loss there. Add it back. So I think that's what we have here. So do we have gain on disposal? No. Do we have amortization of intangible asset? Amortization of intangible asset? Yes. In this question here, if we go back to where we have the non-current asset, in the statement of financial possession, under the non-current asset, you can see we have two assets, PP, property, plant and equipment. Back to the income statement, which we have in note number 4, you'll be able to see that in arriving at that loss of 44, there was a finance cost which is above that, and then you can see there is interest receivable. This interest receivable, we have said that this is a form of an investment income. In arriving at this particular loss, there is the interest receivable, which was deducted, but this interest receivable is not what? Is not an income from operation. So therefore, because it was added in arriving at that, what we do, we less it. I think that's what we have in note 4. Note 5, note 6, no adjustment here. And then I think you have captured most of the items in note number, actually all items which need to be adjusted in our profit, note 1, note 2, and also note 3. So what we need to do here is to get something known as cash flow before changes in working capital. Cash flows before changes in working capital. And then from there we consider the changes in working capital. The changes in working capital. So let's compute that figure there. That is cash flow before changes in working capital. So we need to work out of that. So we have negative 44 plus 24 plus 81 plus 12 plus another 12 plus 110 plus 110 and then minus 12, and that will give us what? That will give us a figure of 183. So that we refer to it as what? The cash flows before changes in what? Before changes in working capital. Before changes in working capital. And then from there we consider the changes in working capital. For the changes in working capital, here we said we consider 3 items. You just need to remember this, RIP, not less in P's, but we consider receivables, inventory, and what? Payables. So you just determine, was there an increase or decrease? These always 3 marks in an exam setup, in an exam. So therefore what you do, you go to where we have current asset, consider 2 items there, receivables and inventory, and then other current liabilities we consider payables. So let's go back to the statement of financial position given under paragraph 1. We consider what? Inventory. So we just need to determine for inventory, was there an increase or decrease? And inventory at the start for 20, at the end 350. So in that case we can see we have a decrease. We have a decrease. Decrease in what? In inventory. What causes inventory to reduce? Because the company disposed or basically sold inventory. So the decrease is 70. What about receivables? Receivables increased. So therefore this decrease in inventory is a cash inflow because inventory increases. So it reduces, that is, inventory decreases because inventory was sold. And then we have increase in trade receivables. Increase in trade receivables means that we extended more credit to our customers. If we give our customers some credit, it is basically a cash what? A cash outflow. So let's determine the increase there. So the receivables increase from trade payables. The trade payables increased from 515 to 530. That is an increase of 15. Increase of 15 in payables of 15 million means that our suppliers, our creditors extended more credit to us. That is a cash what? Is a cash inflow. Yes. Then what we need to do, we basically get the rent amount, we take it to the last column here. So we have 70 minus 436 plus 15 plus 15 plus 15 plus 15, which will give us negative 351. So we deducted from the figure up there, the figure of 183, which is 168, and which is a negative. And then to this, we have said, from the format I gave you, we less the tax paid, and also the interest. The interest paid. So I think here we can start with the interest. Remember, I said interest is another name for finance cost paid. Finance cost paid. So in determining the finance cost, or basically the interest which was paid, here you consider 2 items. One, the finance cost is the income statement. I hope you can remember that figure in note 4, which is a figure of 24. And then you go to where we have current liabilities. In your statement of financial position, you check, was there any accrued interest at the start and also at the end? At the current liabilities, we don't have such. But if you had accrued interest at the start, what you do, you take the accrued interest at the start, which we don't have, then add the interest or the finance cost in the income statement in note number 4, which is 24. But we also have to remember we are given a breakdown for that finance cost down there. A finance cost, we are told, include the penalty on loan redemption. That penalty, we are not going to consider it here. We only consider, we take into account the figure of 18. So we add 18. After adding the two, the accrued interest at the start and the interest for the current year, which is in the income statement, less the accrued interest at the end. And basically that will give you what? The interest which was paid. But now for this tax here, we have to prepare something called the tax account. Remember, we have looked on the format for this. So therefore, we have to prepare that account to determine how much tax was paid during the current what? Year. So let's prepare that account here. The taxation account. Remember, you have looked on the format for this, and I've said in this account what we record is the deferred tax at the start, the current tax at what? At the start of the year, and also we record the same at the end. The deferred tax, current tax at the end. So the deferred tax and the current tax, this is part of the liability. So can we first of all go to where we have non-current liabilities? Yes. At the non-current liabilities, I can see we have a deferred tax at the start of 75. At the end, we have a deferred tax of what? Of 90 as expense. Then we record it on which side? On the debit side. I hope you're together on that. So therefore, the income tax claim is 14. And then below that, we also have something called a deferred tax charge. A deferred tax charge, you can see there is a negative, meaning that this is a deferred tax what? Expense. And just like the income tax expense, any deferred tax expense equally is supposed to be credited in this account. How much is it? Is the net cash outflows. Net what? Net cash outflows. So that's how we determine the net cash flows from what? From operating what? Activity. So having determined that, then we proceed, and now we determine the cash flow from what? The investing activities, and the cash flow from what? Financing activities. So let's start by determining the cash flows from investing activities. And basically this is quite simple because we have computed all the items which we need to take into account here. So what you have here to remember is that investing activities, these are activities involving what? The acquisition and disposal of asset. You take into account the asset which were acquired, the asset which were disposed, and any income from what? Investment. So I think from what we have in working one there, to see we have interest receivable at the start and also at the end. At the current, not at the current liabilities, at the current asset, we have interest receivable at the start and also at the end. So how do we compute the actual interest which was received during the current year? We use the same approach I've explained here for computing the interest paid. So that means that we take the interest receivable at the start, which is 3 million. We add the interest for the year, which is 12, and then deduct the interest receivable at the end. So that will give you the actual amount of interest which was received during the current year. This 15 minus 5, which will give us 10. So that represent the interest, the actual interest which was received by the company during the current year. So and I think those are the only items you're going to consider here. So what we need to do before we determine the cash flow from financing activities, so let's get the net amount. We have 15 minus 60 minus 110 plus 10. So this will give us a net cash outflow of what? Of 145. And then finally we need to determine the cash flows from financing activities. From financing activities. And basically I've said that all the items which we include here, we get them from equity and non company receive money, so which is a cash inflow. Then below that we have share premium, which also increased from 0 to 60. So we have increase in share premium. The reason why share premium increases is because these shares which were issued at a premium, so which is still a cash inflow. And then below that we have revaluation reserve. Revaluation reserve, we don't consider it here because this is a non-cash item. It basically these are reserve which changes because there were some assets which were revalued. The other item which we have below there is the retained earnings. Now this retained earnings is used in terms of computing the dividends which were paid. But if you can read loan notes, and basically you can see the figure was they increased by 160. So basically this is the amount which was received by the company by issuing other loan notes. So I think that what we have, deferred tax, we don't consider it here because we used that in terms of computing the tax which was paid. So therefore you can see all those particular figures there. We have gotten them from where we have equity and non-current liability. So what we need to do, can we get now the net cash flows from investing activities? We have minus 156 plus 160. So that will give us 139, which is a positive 9. So that will give us negative 273, negative 273. And then to this we add cash and cash equivalent at the start of the year. So in this case, when we talk about the cash here, we said we consider cash in hand, cash at bank, including bank overdraft and cash equivalent. These are short-term investments. So what we do here, we go to where we have current assets. We take into account the items of cash and cash equivalent. So at the current asset, which items of cash and cash equivalent do we have there? First of all, we have the bank balance, which was now at the end of the year. So we need to add these two figures here. What we have there plus this. So we have negative 273 plus 195. Okay, negative 273 plus 195. So this will give us negative 78, and actually this one should be the same with the cash and cash equivalent in the statement of financial position. So how do we get the cash and cash equivalent at the end of the year? We take the short-term deposit at the end of the year 32 plus now the cash, the bank balance at the end of the year 15, and then to this we less the bank OD, the bank overdraft, and the current liabilities. So whatever you get here should be the same with that. And if that is the case, automatically
allowable legal costs. Allowable legal cost number 1 is the legal cost for a lease. Legal costs for a lease not more than 99 years. 99 years. So when you're doing your business and you decide you want to occupy a property, let's say a building, and that building you are going to occupy for 99 years, 80 years, 70, 10, 5 years, 1 year, and you decide to make it legal, you require a lawyer to help you in taxation of your business, that you are allowed to deduct that legal cost when you're determining the taxable incomes of the business. After that, we have relating to customers and debtors. Although debtors are your customers, but it's good to specify, because most of number 4, we have legal costs
to list a company at stock exchange. We normally have what we call listed companies or quoted companies. These are companies whose shares are traded at stock exchange market. In Kenya, we have Nairobi Stock Exchange Market. That means anybody who may want to become a shareholder of that company just need to go there and you buy shares of that company. It's open. When that company was getting there, it could have incurred several costs. One of them was to hire a lawyer to help them in preparing the document for presentation to, for example, Capital Market Authority, for them to be allowed to, for their shares to be traded there. That legal cost they paid when they were getting there, it's supposed to be an allowable expense. Number 5, legal costs to defend property rights. It means you have, for example, land somewhere. You own that land. Or you could be owning a motor vehicle. Somebody from outside just come and say, this land used to be mine. This motor vehicle used to be mine. It was stolen from me. This building used to be mine. You decide, no, I bought these items legally. So you decide, let us go to court so that the judge can decide who owns these items. And because you are not a lawyer, you hire one to go and represent you. In the process, he charges you some legal fee. That is the one we are saying legal cost to defend your property. And when you pay, that become an allowable expense. The last allowable legal cost, number 6, is the legal cost relating to tenders. Tenders relate to your business. For example, you want to supply something to your customer. They tell you you have to tender. But maybe because you don't know the process of doing that, you hire a lawyer. Come and help me prepare these tender documents. They charge you some legal fee. That legal fee is supposed to be allowable. So these are the allowable. Look at non-allowable legal costs. Defend you. That legal cost will not be allowed by the taxman to come and deduct it in the business. Why? Because it is not business related. You are not doing business. So that is usually not allowable. Number 3, legal costs relating to bank loans, bonds, and debentures. Now, we are talking about legal costs relating to bank loans. Why don't we allow them? Because being in the long term means if the company lasts for 25 years, that memorandum of association will be there for 25 years. So it's a long-term document, not revenue. We call that capital expenditure. Partnership deed or agreements, the same. These are agreements that are signed between partners. And this agreement will be there in the partnership as long as the partnership is there, guiding the partnership, how they are supposed to operate. So it's a long-term document. So we don't usually allow based on that. After that, we have number 5, legal costs relating to patents, copyrights, and trademarks. Amount of tax. But you're not satisfied with that. You decide to appeal or even object, but you don't want to do it directly. You hire a lawyer to come and help you in your defense. That legal cost you pay there is not supposed to be allowable. And this we are going to learn. It does not just restrict itself to the tax matters or legal costs relating to tax matters. It also says that all other expenses, as long as they are connected to tax, they are usually not supposed to be allowable because it's assumed you are the one who is supposed to handle your own tax issues. The last one, number 8, court fines and penalties. Now, when you talk of court fines and penalties, when you are fined, it means that you are the one who was on the wrong side. So several allowable and also non-allowable, and we had to look at them. So we go back to the list of the allowable. After number 5, we have number 6, another allowable expense of the business. Number 6, payment to trade associations. Now, to differentiate this allowable expense numbering, as you can see, we have number 6 here. From this allowable legal cost and unallowable, let me rename this one as A, B, C, D. Operating a bank, they normally have an association called Kenya Bankers Association. It is there to improve the banks, help to fight for the interest of the banks. If you are in manufacturing, there is an association called Kenya Association of Manufacturers. It is there to trade and protect the interest of the manufacturers. So when a business pays to this association, it is helping to strengthen them, to help them fight for their interests. So that amount is supposed to be an allowable expense. Number 7, another allowable expense is the employer contribution on behalf of employees to pension schemes and provident fund. Which are these schemes? Pension scheme. We have advertisement expenses of revenue in nature. So the key thing there, we said these are expenses you incur and the benefit is realized within a short period of time, usually within a year. So when it comes to the advertisement, you may find advertisement on radios, TVs, newspapers, preparing brochures. When you advertise in them, it is usually assumed, for example, when you advertise on radio, the customer can already remember what you have advertised within probably 2 weeks, 1 month. After that, they might forget what you advertise unless you continue advertising. So it's revenue. The third year, 10% that way, but on a reducing balance. So capital advertisement expenditure is usually not allowable. Then we go to number 10. Number 10, of another allowable expense is the on behalf of employees to members club. But that members club must be related. Employer contribution on behalf of employee to members club. A good example of this is accountants to charitable organizations. That is supposed to be another allowable expense. Question is, which are these charitable organizations? According to the Income Tax Act, it is specified that they include any organization that advances religion, education, or to alleviate the poverty in the society or suffering in the society. If you look at that definition, religion, we are talking about churches, mosques. When you talk of education, we are talking about schools. When you talk of alleviation of poverty or suffering, we are talking about allowable expenses. After that, we have number 14. Payment to directors of a company for service rendered. Expenses of the business, and this is according to the Income Tax Act. You get them there. After looking at the allowable expenses, we need to look at non-allowable expenses. These are expenses which cannot be deducted against the taxable incomes of the business. Which are these non-allowable expenses? We have number 1, non-revenue stroke capital and non-commercial debts. The other way to put it is increase for bad debt. We had said if it is specific provision for bad debt or increase in specific provision for bad debt, that is allowable. General provision, we said, normally arise as a result of estimate. For example, at the start 20, at the end 25. That year it means that you created 5 million more. That is not supposed to be allowable against the taxable incomes of the business. Number 4, we have depreciation. Depreciations are usually not allowable. And we said depreciation are usually not allowable. Reason, they are long-term costs. So you benefit out of them in the long term. So we don't usually allow them. Number 6, we have loss on disposal of fixed assets. Fixed assets. That when you dispose your fixed asset, like if you have motor vehicle as a fixed asset, furniture as your fixed assets, and you dispose them in the course of your business, if you generate a loss, it's usually non-allowable. Private expenses of the owner. So, we had also mentioned here that it's also important to note specifically expenses relating to the owner, electricity expense relating to the owner, salaries, rent, name them, water at home, don't bring them into the business. They are not usually allowable because they are not commercial. Number 10, we have all forms of taxes, or legal fee to hire a lawyer, any other. Sometimes you may not have paid your taxes, and the taxman charge you the penalties, charge you the interest on the tax overdue. All these are not supposed to be allowed. Any expense related to tax, we don't usually allow. Number 12, 10 years. Those are usually not allowable. What do we mean? That if you generate a loss in the business in 1 year, let's say in the have provision for salary. Like if you know next year you have salaries to pay, next year you have rent to pay, you may provide it in this year. That this is the provision for salary reserved somewhere to be used when that time comes. You normally find, like in partnership, the partners may be working in their business. So they decide to pay themselves salaries, commission. Sometimes they charge interest on capital they have invested in the business. Because they are paying themselves, that is usually not allowable. Anything paid to the owners of the business. Same case when it comes to the company. The company is owned by shareholders. So I pray that you go through them all alone, look at them one by one, try to understand what we have explained. So for now, I think for this topic is over. Then it's my hope that I'm going to see you in our next topic. The next topic would be about one of the allowable expense that we had here, the allowable expense number 4, where we talked about capital allowance. In the capital allowance, we said it is usually granted in place of depreciation, where we say depreciation is for accountant. In taxation, we call that capital allowance. And we said it is used in relation to the cost of fixed asset. So how do we grant capital allowance? And if I remember, it's also said there are several. There is an investment deduction, industry
cash flows is 25 million. The annual cash flow growth rate from year 2 is 10 million. The project life is 5 years. You are required A, compute the following project metrics: payback period, number 1. Number 2, the net present value, assume a discount rate of 12%. Number 3, the profitability index, assume a discount rate of 12%. B, using a graph, determine the project's internal rate of return. And this totals 30 marks. So trying to answer this question gives us or gives you 30 marks there in total. So to start us off, we are first of all going to do the following. We're just going to first of all come right here and we say we have the year given to us over here. Given to us. And this gives us year. So we have the years given to us. They're from year 0, 1, 2, and of course you know what happens once you put it like this, and then you have that plus sign like that, you can drag it up to the number of years you actually want, like that. So let's assume it goes all the way to year 5. Not assume, we've been told it goes to actually to year 5, and you can be able to see the project life right over here is 5 years. So from year 0, and we are saying from there, then we need then to put the value over here. We're dealing with Kenya shillings, so shillings, put shillings, and we are saying we can put them in thousands. That all of these need to be put in terms of thousands over here. That why? Because we're dealing with thousands. We just do not want to deal with very big figures like that. We just want to deal at least with manageable. And here, the initial investment. That. Then we can put the initial investment right here as 100,000. Why am I putting 100,000? Guys, because you're saying that we are expressing it in terms of thousands over here. Yeah. And the residual value is assuming that you sell the asset at the end of the project, or after 5 years there. So right here I can put over here in terms of the residual value, you can put 10,000 here. You sell an asset and you realize 10,000 in terms of value. Once that happens, then we can move ahead and look at the values over here in terms of the net cash flows over here, the cash flows. Cash flows. And you're saying the cash flows over here, we've been given the initial investment is 100 million. You're saying the project 1 cash flows is 25 million over here. So assuming that this is, of course, is the initial investment. We can put a negative value over here like this. We're saying that we can be able to put, so it's negative, I just sort of put negative, enter, it can be able to appear, and that it's an outflow. We can put the values over here as follows. For year 1, we're saying is 25,000. Not right there, you can put, because this is the residual value, the cash flows here, 25,000. That, and we're saying this 25 million or 25,000 over here, in our case here, is going to grow at an annual rate of 10% from year 2. So from here, we can do sort of something like so. We add that value and multiply it by a factor of 10%. So times 1.1. That. We get 27,500. Then we just drag it, because this has got a formula. We drag it sort of like that. And we make sure at least it auto fits within the cells. So from there, we are saying that what is going to be our flows. Then, so here we're going to pick this value here. The ones we're going to discount, these ones are going to use this value here. And then we are saying we're going to use, just going to pick the residual value plus the cash flow itself over here, if any. So that now it, after period 5, we expect this cash flow to be 46,603 over here to be the cash flow you're going to discount back to period 0. So we drag it and it picks. You can see now these are the cash flows which you're going to discount over here. You can put them in bold, Control B. That, of course, we can be able to expand it by sort of clicking, double clicking like that. Those are the cash flows. Once we have that, we can then get the payback period. So over here I can write now the payback period. Because that's what you're looking for, payback period. This means that we need to get the cumulative. Cumulative values. I can be able to just put it sort of like that. And we come right here and put it maybe in form of a box like that. So that's what you're interested in, the cumulative cash flows. So here, it's just going to be that value. And then we are going to pick plus that value plus this net cash flow here. Comes to 75. And then we reduce it. We continue. We drag it because it's got a formula. We continue up to there. But if we continue over here, if we get 33,000, we subtract, because of or 17,000, we subtract 33,000, we should be able to get a positive value. What the payback period tries to measure is how much you can be able to recoup this original investment of ours over here of 100,000. So clearly over here we'll be able to get a positive cash flow, yes. But in terms of the payback period, in terms of years, you can see the number of years given to us right here. We can say that the payback period, so payback period over here will be given to us right over here. So this is year 1. We can say year 1, indeed, we're still getting a negative cash flow. Here, year 2, we're still getting a negative cash flow. Year 3, we're still getting a negative cash flow over here. But when we reach year 4, we are going to get a positive cash flow. This, let me just demonstrate. We're just going to get a positive cash flow over here like so. And that's not what we want. We want to recoup this original investment. We do not want a positive cash flow. We want to see the exact number of years we're able to recoup this 100,000 right here. So just delete that. We know it is going to be 3 years, but 3 years and how many months? So we can be able to put the number of months right over here, or we can be able to compute it right here. So it's going to be that value over this value, and then we multiply by 12 because we want it in terms of months. Like that. So 6.22 months. So the payback period we can say is here. Payback period is 3 years, 6.22 months. That is what answers our first part right here, the payback period. So we can move ahead to part B, the question over here. And part B, we can just go down right here. B. It's a similar fashion or a similar format. We are looking for the net present value right here at a discount rate of 12%. So net present value. Net present value. And we're saying the net present value is, just given, is just how much we are able to get. Are we going to realize a positive cash flow or a negative cash flow based on discounting? You're using a discounted cash flow technique so that you can be able to get the present values. And in a similar way over here, so we're not in B, we're doing part A, part 1. So this is A, part 1. I can just put it like so. This is A, part 2. A, part 2. Like that. So that now we can be consistent there. And to get the net present value, what we'll need to do, if you allow me to copy this over here like this, cash flow, the cash flows over here, I can be able just to copy these ones the way they are like that. Copy, just put them just down here. So, and of course, I'll be able to also copy this. Allow me to copy this. Copy, put it just down here like so. And this I can drag it maybe down. I can just drag it somewhere down there like that. So the initial investment, we just pick this from above here. And then we're saying the cash flows, we're just going to pick whatever we have right above here. So we're linking it like that. And we're saying these cash flows are the ones which we will need then to discount. So this is how we're going to discount it. So the net cash flows, we still pick them from above there. Net cash flows like that. And then we have this value like that. And this is what we're going to discount. These ones over here. These net cash flows. You see, like the way I've did over here, the relevant values, these are the ones which are we're going to discount and get the present values right over here. So present values. So the present values will be, we're going to get this value over 1 plus r over here. But for us to be able to get the present values, or there's in Excel, there's always a way we can be able to get the present values. Always. There's always a way how we can be able to do it. And we can just say the NPV. Instead of discounting this value over 1 plus this value over 1 plus the discount rate power 2, power 3, power 4 and power 5 like that, we can just go to the to a formula NPV like that, and we are saying we open it up right here and we can see the rate. The rate is just 12%. And once we have the rate as 12%, under the value 1 here, we put in those cumulative cash flows like that. And then we will need then to subtract the initial cash outlay. So would it be correct for me to add right over here? We add the initial cash outlay there, like that. That's the initial cash outlay. So that's what we are saying we are going to have. 13 million, of course, because we're dealing with millions, 13,365,000.99. That is what you're saying represents NPV. And so you can maybe highlight the answers maybe in red like that, so that you can be able to know that these are the answers. We can move on and discuss about the profitability is the net of present values to try and see whether you're able to get a positive cash flow or a positive value or a negative value. If NPV is positive like this, we accept the project because the project is going to yield us positive values in future. But if you get a negative NPV, then it doesn't make any sense to us here. So here part 3, I can move ahead right down here and now click this one to be 3, the third one. That. That. A part 3. We talk about profitability index. Index. That. Under profitability index, we are going to get the present value of cash flows divided by the initial cash outlay. That gives us the profitability index. Any number greater than 1 gives us positive, or we are supposed to go ahead and invest in that project. If it gives us anything less than 1, then we reject the project. And we are told to assume the discount rate of 12%. So what we do is that we just go ahead and use the similar values right over here. Copy. We come right here, or rather I should have copied from here, sorry. Copy, and you put it right maybe just down here. Paste special, we want to paste special formulas and all. Oh, it's refusing, so we just look for an alternative way, put it like that. So with these values, we can just link it with the first value right over here. So just link it with that one, that, and we can just drag it moving across like that. The residual value picks from here, that. So these represent the net cash flows. So this is what we're saying is shillings, so we just delete this and it's okay. But the initial investment picks from here, the net cash flows, that value there. So once we have that, then we can be able to get the profitability index. Index. And the profitability index, we are going to get the present value of cash flows divided by the initial divided by the initial cash outlay. So we're going to use NPV rate 12%. The values, we are saying we're going to use these values here. And there's one thing that we needed to change here. We need to add the two values, these two values here, before we continue. That one plus that one there. See the profitability index, NPV. See here, double click it. Then we open it up right here. And you see the rate is 12%. And then with 12%, we can put in the values over here like that. We are getting that value, the present value of cash flows, and we are going to divide this against the initial cash outlay. So minus, open the brackets, this one. Enter. That's what we get as our profitability index, 1.13. So in this case, we accept this one based on NPV, we accept, and the payback period, if it's the shorter the payback period, the better it is for us. So here, just like for consistency purposes, we put it in red like that. And we can see that we're moving on well, and we now move on to part B of the question. Using a graph, determine the project's internal rate of return. The project's internal rate of return is at the point where you get, the NPV is equals to 0. Where the NPV is equals to 0 is where we are saying our project's IRR is going to be. And so we're going to use a graph. So first of all, you're going to test it using the IRR formula. So IRR, or internal rate of return. Rate of return. The internal rate of return, IRR, is going to be, we open it up right over here, the values. So we put the values right over here, all of the values, including the negative value here. And we say, okay. So it's around 17%. And that's what we expect, or 16.75%. That's what we expect from using the graph, around there about. So we pick arbitrary rates, so 12%. You can put 12% over here, 13%, like that, and so on and so forth like that. So we just drag it. So we can just get arbitrary rates over here, and we get the corresponding NPVs. So NPV over here, 12%. The rate is 12%. You can see from right over here, 12%. The values over here are these ones here, the net cash flows here, like that. And then we do what? We add the initial cash outlay. The initial cash outlay in this case was negative here, that, and we get that value. So it's the same as what we got above over here. That's fine. But because we want to ensure that we want to get the corresponding NPVs at different rates over here, I need to lock the formulas over here. So I press F4 there. I click over here, I press F4, and I press F4 over here, so that I can be able to lock and ensure that everything is okay. So if I drag my formula over here, it should be able to work. So that's what I'm going to do right here. So Shift, Control D. But it's picking 13%, or it's because I didn't change. You see, it's still at 12% here. So what I'll do, I'll just change this to 13%, 14%, like that, 14%, 15%, and so on and so forth. Just come and change here, 16%, 17, that, then 18, So don't worry about that. 19. Then here we got 20%. 20%. Like that. So you plot a graph over here. This is the NPV. NPV, that rate. Like that. So just sort of put it center to make it look presentable, and like that. Then you can just draw a graph here. Insert. Then you come to recommended charts, and you can be able to see, based on this graph over here, that point, okay, just place it somewhere right here, that at around 16% over here, you can see at around this point here, if you click right here, it will give you the point. At around 17% is when you're going to get negative NPV thereabout. 17%. And you can see it's 16.75 right here. So the exact rate should actually be somewhere over here where it's next to. It's along just this curve over here. It cuts it along. So ladies and gentlemen, this brings us to the end of the class. We have done question 22 of the Business and Data Analytics paper, which came in December 2023. Hope you have enjoyed it. God bless you all. Bye-bye.
Receive my greetings and welcome back to the strategic management lesson. In today's lesson, we are going to learn about two concepts, that is uncertainty and strategic drift. Those are two concepts. One, uncertainty, and strategic drift, which are intertwined concepts in strategic management, where strategic will define strategic drift in the context of strategic management. Then we'll look at the relationship between the two. But I've said that the two are concepts that are interrelated. They are intertwined in strategic management. So what is uncertainty? Now, in the context of strategic management, uncertainty difficulty in future events. Uncertainty refers to the lack of predictability and the difficulty in forecasting future events. And I've said that this unpredictability can arise from various factors like the external environment. By external environment, I mean the changes in technology, changes in economic conditions, changes in the political landscape, social trends, shifts in organizational culture, which can also contribute to internal uncertainty. You understand? Other factors are just complexities. And by that I mean complex systems with multiple interconnected variables, which can be inherently unpredictable, leading to uncertainties in decision making. So that's the meaning of uncertainty. The unpredictability and the difficulty in forecasting future events. Then what is strategic drift? Strategic drift. Strategic drift. on the other hand, occurs when an organization's strategy gradually becomes misaligned with its external environment. Occurs when or failure to recognize emerging threats and opportunities. So because we know an organization operates in an environment that is continuously changing. The political environment is changing, economic environment is changing, technological environment is changing, the social environment is changing. So when the organization fails to align itself with these external changes, then we say that that is strategic drift. It occurs when a company strategy gradually becomes misaligned with the external environment. Do you understand? It is a slow process, a slow and subtle process that can happen over time as the organization fails to adapt to changing circumstances. Because changes can be slow. We may have one law this year changing, another year another law changes, but the organization does not adapt. We could have changes in even customer preferences. We've said that uncertainty creates a breeding ground for strategic drift. That is to say, strategic drift happens due to uncertainty, which is the inability of a company to forecast future events. When a company fails to forecast future events, then when these events happen, the company is caught unaware and the company becomes unable to align the how it actually happens is one because of incremental change. Let me explain. One, there is incremental change, and this incremental change is change in the environment. All right? When there is incremental change, continuous change, and the organization makes small incremental changes to strategy, but these changes are not sufficient to keep pace with this is a big misalignment. So there is that period of decline or confusion as the organization tries to catch up. It tries to respond to the growing misalignment. You understand? Then after that period of confusion and instability, then the company will decline or transformation or decline. See how that is very possible. We operate in an environment that is continuously changing. There's nothing that is constant. And if the organization the strategy of the organization remains constant for a long period of time, yet there are changes happening, then ultimately such organizations do not succeed. So now the question arises, how can strategic drift be prevented? So it makes sense for us to address that point. Strategic drift. One is through environmental scanning. encourage employees to challenge assumptions, to embrace new technologies, new ways of doing things, to be more creative, and to be open to change. That is one way to prevent strategic drift. 5, strong leadership is another way to prevent strategic drift. Leaders play a crucial role in recognizing of uncertainty that organizations face in their external and internal environments. 2, explain how strategic drift happens gradually and what are the key indicators that an organization might be experiencing it. 3, what are the potential consequences of strategic drift for organizations, for an organization's performance, competitiveness, and long-term survival? 4, what strategies can organizations implement to mitigate the risks of strategic drift and maintain alignment with their changing environment?
So I'll call this the partnership name Kasneb. Income distribution or allocation schedule. And then here we noted there were 3 partners, by the way. So I'll read this so that I can introduce the 3 partners. I'll give them the initials. As you have seen, there's Kamara. So I write KA to stand for Kamara, Susan, SU, and Kubasu, KU. And then totals, because of the space. So shillings, 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 shillings. So we had said $500 plus 185 plus 146, which give us 738,500. Then the other one that we had here was the commission or bonus to partner. But I'm very sure as we went through the question, there were no commission or bonus to the partners. Which is a negative. Same case here, because it's for each, and the other one is 629,417. All they are, remember, are negative. So from there now, we need to get income, operating income. So total taxable operating income would mean we take this plus this minus this because it's a negative. The same case for everyone. So we start with 600 for the first one, 1,000 plus 4 plus 146,000 minus 629,417. This is a loss of 258. So negative 258, 417. Then now we get the total, which would be 1275,000, and then we add 738, 500, and then we minus 1888, 250, which we 125, 250. And that answer, you'll find it is starting with the operating income, because remember we are you are given an income like dividend or interest, and you're not told where it's coming from. Always assume it's a non-qualifying dividend or non-qualifying interest. Like this one, they have not indicated where it's coming from. So being non-qualifying means that the withholding tax was not final. We need to tax it further. So the dividend that we don't put here are the one that we indicated as exempt or qualifying, because exempt are not taxable, and here we are talking about taxable. Qualifying, withholding tax, if it's final, you are not supposed to tax it again. So only non-qualifying. So this one, being that it has not been indicated, we assume it's non-qualifying, so it should be here. So dividend income. The dividend, there is another investment income, rent. We said if you're not told where the rent is coming from, you assume it's a commercial rent, so that you tax it further. So here we have not been told. And then for the rent, you must minus the allowable expense relating to rent, repair, caretaker salary for the rental. But for this question, we haven't been told whether there were any expense relating to rent. So we distribute the way it is. So rent income, which we have 415,000, and then profit sharing ratio each for 15, divide by 3, and that is how we determine the taxable income of the partnership, and we do the distribution. For now, we are going to stop there until I see you in our next lesson, where we are remaining with one business, that is the limited company. We see how limited companies are usually taxed. Thank you very much. However, make sure that you do the assignment that is being shown at the end of this video. Thank you very much.
So number 4 of topic number 5, share capital. So in this 4th lesson, I want to talk about the purchase of own shares, by a company. Then I will also talk about dividends, the dividend law in respect to companies. So let me begin on the first of those items, where we are talking about by purchase of own shares, by purchase its own shares. Or could a company by extension finance the purchase of its own shares? Now, we notice that there is a direct prohibition against companies purchasing their own shares or financing the purchase of their own shares. At common law, these exceptions include exceptions to the rule, that is exceptions to the rule in Trevor versus Whitworth. These exceptions introduce us to circumstances where a company may purchase its own shares. Now, one of those circumstances is for protection of protecting minority, for the purposes of protecting minorities. Where we have circumstances in the company, imagine circumstances such as a variation of class rights that is proposed and even voted accordingly, but we have some minorities who are contesting the variation of class rights on the basis that it is prejudicial to their own interests. We may have a court order directing that the interest of these shareholders
minorities actually, these protesting or these objecting minorities be absorbed by the company. In such an incident, transaction would be a company purchasing its optional cases. They are presenting us to a scenario where we are going against the directions given by this company with the proceeds where a company has financed the purchase of its own shares. The other exceptional case would be where the company has a scheme, to advance, money or funds to trustees, to a trustee or trustees to acquire shares for the benefit, in the purchase. Let me now look at dividends. Return. This is a member's return for their investment. In the company. A member's return of maintaining the company's capital. One of the paramount rules relating to the payment of dividend is that dividends can only be paid out of profits. Dividend can out of profit. Dividend can only be paid out of profit. That unless a company has realized a profit, then this company cannot pay dividend. And by the way, inherently, companies are not under obligation to pay a dividend. It is financial year end, we have made profits. The company is dead as the company's realized profits in this year, including the exclusion or the deduction of any realized losses from revaluation of assets that this company has done during this year can be excluded from the company's annual realized profit that year. Company's realized profit as profit available for payment of dividend. Profit available for payment of dividend. The other rule is that dividend the approval, declared and approved dividends, shall not against the company if there is a delay, in payment, that the board has recommended a certain rate of dividend, which has subsequently been approved by the members at a general and approved within 42 days of such approval, the dividend should be paid. Register after the approval of the dividend. Then the company can proceed on now to prepare the dividend warrants, which are to be counter-checked and sent to members in respect of the dividend payable to them. So class, that brings us to the end of our lesson number 4. If we can recap what we have looked at so far, we have looked at the purchase of own shares by a company, where expressly such purchase has been prohibited. And we have also looked at exceptional circumstances where such purchase can be done and the financing for the purchase can also be done. We have also looked at dividend, what it is. We have looked at the rules relating to payment of dividend, and we have also made a mention of the procedure to be followed by companies. Just to show you some of the questions that we have had from this particular topic. We have a question here asking candidates to advise shareholders on the distinction between nominal capital and reserve capital. We have a question asking candidates to explain 5 ways in which a company might alter its share capital. We have also a question here asking candidates to discuss the actions and omissions that are considered to contribute to criminal behavior in relation to preparation and issuing of prospectuses. So there are many questions here that I would wish to refer you to help you in the revision of the content in this topic. Thank you.
Hello learners, welcome today to our today's session. We are doing a mathematical approach to the theory of costs. Mathematical approach to the theory of costs. So we normally have 2 different types of questions set on this. So you already have figures like on the level of output, you are given the fixed cost, you are given the variable cost, and then you can be told to use that to calculate the total cost, the marginal cost, the average fixed cost, average variable cost, and the average total cost. So in case you are given such a question, then how do you go about answering that question? So I'll give an illustration. We are assuming a case where you've already been given the level of output, you know the fixed cost, and you know the variable cost. How can you use this to derive all other costs of a particular firm? So I'll give a table. Then we have fixed costs. So we said that fixed costs will remain constant all through. So fixed costs are not changing. Output is increasing by 1 unit, and then these are the variable costs that we've been given. So how do we calculate the total cost? So to calculate the total cost, we said that total cost equals fixed costs plus variable plus the variable cost to calculate the total cost. So for this at 0 output, we are taking 50 plus 0, which will give us a total cost of 50. Then for the next 1 unit, we have fixed cost 50 plus 20, 50 plus 30, which will give us 80. 50 plus, we say this change in total cost over change in Q, which is 2. So whenever we've been given such like a table, the formula that we'll use in this case is this change. And where we've been given a function, then this is what we will use. So for this case, we are using this change in total cost over change in Q. So this is simply the same as we are taking Y. When you are not producing, no variable cost will be incurred. And when we are beginning to produce at unit 1, the variable cost is now 20, and it has increased the total cost from 50 to 70. So what is the change? It is simply that 70 minus 50. So at our 0 level, there is no marginal cost that is incurred. But when we are beginning to produce 1 unit, that is bringing a change because of a change in the variable cost, then the output is increased to 70. So to calculate the marginal cost, we are minus 1. So because we are increasing the level of output by 1, that means we will simply be dividing by 1. So it is the same as 80 minus 70 over 2 minus 1, which is just the same as 30 divided by, 10 divided by 1. So the marginal cost for the second unit will be 10. And then 85 minus 80 divided by 3 minus 1 will give us 5. Then next we have 95 minus 85. That average variable cost equals total. Our variable cost for output unit 0 was 0. So this will give us 0. Then for the first unit, the variable cost is 20. To calculate the average, we are taking 20 divided by 1, which will give us 20. For the second unit is 30 divided by 2, which equals 15. For the third unit, we have 35 divided by 3. And this is equal to 11.67. For the fourth unit, the variable cost is 45. So 45 divided by 4 will get 11.25. For the fifth unit, we have 65 divided by 5, which equals 13. And for the last unit, the variable cost is 110 divided by 6, which will give us 18.33. Then lastly, how do we calculate average total cost? So we say that average cost or average total cost equals average fixed cost plus average variable cost. So since we've already calculated the average fixed cost and the average variable cost, we simply sum these together. So we'll have 0 plus 0, which will give us a 0. 50 plus 20 will give us 70. 25 plus 15, this is 40. Then 16.67 plus 11.67 equals 28.34. Then 12.5 plus 11.25 equals 23.75. And 10 plus 13, this is 23. Then we have 18.33 plus 8, which is 26.33. So that's how we answer such a question. We have another type of question where you are given functions. So where you have been given a function, then you need to know which function is this before you can go up to solve such a question. And because we said to calculate marginal cost, we find change in TC or in total cost divided by change in Q. So this means that function has to be differentiated, or the total cost function will be differentiated for you to get the marginal cost function. Differentiation is, or just to give a short illustration of how we differentiate functions. Like assuming you've been given a function like y equals 2x cubed plus 10x squared plus 15x plus 110. And then you are told to differentiate that function. Differentiating simply means finding the derivative of that function, or what we refer to as finding the dy over dx of the function. So it will be 20x. And then next we are plus, this x is the same as x raised to power 1. So I say that in mathematics, we are not saying that it is x raised to power 1. We are just writing x, but it is x raised to power 1. So to differentiate, we are taking this 1, we multiply by the constant, which will give us 15. And so we reduce this power by 1. When you take 1 minus 1, we'll get a 0. And that means we'll have x raised to power 0. So x raised to power 0 is in the total cost. So in such a case, you may be asked to identify or to determine the fixed cost function, determine the variable cost function, and use that again to calculate the average fixed function as well as average variable cost. So how do we go about that? So I'll use we're assuming that we've been given a total cost function, which is a cubic function of the form A plus BQ plus CQ squared plus DQ cubed. So a cubic function is simply that function whose highest power is 3. And so in this case, when you are told to identify or determine the fixed cost, what are the fixed cost or what is the fixed cost function? Fixed cost is simply referring to the constant part of that function, and in this case, it is just equal to A. So when you are told to determine the fixed cost, sometimes or maybe the fixed cost function dq cubed. And then sometimes you can also be told to calculate now the average total cost. How do we, before I come to average total cost, we'll be told to calculate the average fixed cost. How do we calculate the average fixed cost? So we say that our fixed cost equals A, and we say that to calculate average fixed cost, it will be equal to fixed cost divided by Q. So that means if our fixed cost equals to A, then our average total cost. How do we calculate average total cost? We say that it equals, right? Average total cost equals total cost divided by Q. So we were given the total cost function, which is this. So if that is our total cost function, if TC equals A plus B Q plus CQ squared plus DQ cubed, then to get average total cost, we are simply average total cost, we are dividing the whole of this by Q, which is the same as A over Q plus BQ over Q plus CQ is equal to, it will be equal to A over Q plus B plus CQ plus DQ squared, and that will be our average total cost. There are again some instances where you will now be told to calculate the marginal cost. So if you've been given the total cost function and you are told to determine the marginal cost function, what we do is you simply differentiate the total cost function. So differentiating the total cost function will give you the marginal C over change in Q. So if our total cost function is, if our TC equals A plus BQ plus CQ squared plus DQ cubed, then to find MC, we are simply finding the dy of, and what will it be? I say that whenever we have a constant, that constant will automatically disappear. So A will not be there. Then Q is the same as Q raised to power 1. So we take 1 times B. So we'll have B. We reduce we reduce 1 by 1. And then Q will disappear. So we'll have B plus, then CQ. We are taking the power, we multiply by the constant. So we'll have 2 multiplied by C, which will give us this part. Assignment. And this is the assignment. You are told that the total cost, cost and demand functions of a firm of a firm under monopolistic competition are represented as follows. So total cost equals 850 minus 8Q plus 10Q squared. P equals 200, where total cost equals, TC equals total costs, Q equals output, and P equals price. Then required part one of the question, fixed cost function. Fixed cost function. Part one, we have fixed cost function. Then Roman 2, variable cost function. Roman 3, average. So you'll try the question using the principles I've given, and then you'll be able to get all that you are required to get. So bye-bye. Let's meet in the next session. Hello learners, welcome to Manifested Publishers e-learning portal. In our today's session, we are looking at costs of production or theory of costs. So theory of costs can be looked into two perspectives. We normally have the long run and the short run. So I'll begin with the short run analysis of costs. Short run so short-run analysis can be looked into two perspectives. We have the long run and the short run. So I'll begin with the short-run analysis of costs. In the short run is where at least one factor, input, must be fixed. Fixed means when the market conditions change, that factor will not change. So like for example, factor. This is a factor which does not change or vary, with the level of output. So it remains the same. Graphically, if we are to present a fixed factor, this is how it will look like. So this is a fixed cost. So this is the level of output, which is in units. And here we are talking of costs. So we begin from zero output. So when you are producing zero output, a fixed cost will still be incurred at this point. Even if I increase my output as total cost, this is the sum. This is the sum of fixed and variable costs. So how do we illustrate this? This is how we represent a variable, a total cost. So we have 0, this is output level, which is in units. And then we have cost. So the costs here are fixed when total variable costs are rising. Initially, we do not have any cost that is incurred. The only cost that is being incurred here is a fixed cost, which is remaining constant. So when we have 0 output, where we have 0 output, so that means no output is produced, fixed cost equals total cost. Where there is 0 output, fixed cost equals total cost. But the time variable costs begin to rise as the level of output changes, then total cost will begin to rise. So at the time variable costs are as average fixed cost. Average fixed cost. Average. What is average fixed cost? Average fixed cost is simply the fixed cost per unit. Fixed cost per unit is the fixed cost per unit of output. Or to get average fixed cost, which can be abbreviated as average fixed cost, we simply take the total, reaching the x-axis. It can never reach the x-axis. That is the average fixed cost. We also have another one known as, this was our number 1, number 2. This is number 3. I can call this number 4. So we move on to number 5. So our number 5 cost is average variable cost. Average variable cost. This is the variable cost per unit. So average total cost, this is our number 6. Average total is simply the total cost per unit. Or is average fixed cost plus average variable cost. Marginal cost. So a marginal cost is that cost is an additional cost that arises, or it is a cost that is increasing the total cost just because of an extra unit that is produced. So the cost that is incurred for producing an extra unit. So in simple words, what is a marginal cost? Like, for example, we have the average variable cost. Then we have the marginal cost, and then we have the average total cost. Average cost, the average total cost must be at its minimum. And then once we have that intersection, when the MC is above the average variable cost, the average total cost is increasing, the average variable cost is also increasing, and then the average fixed cost is falling continuously. So as others are rising, this is falling continuously, though it is not able to reach. So we say it is asymptotic, meaning it cannot touch or intersect with the fixed cost, the variable cost, the total cost. Be able to explain, be able to back up your explanation with the graphs required. And then we also have average cost. We mentioned fixed average fixed cost, average variable cost. We have average cost or average total cost, as well as marginal cost. Be able to explain, and what are the graphs. If they are required in your exams, you should be able to explain, backing up your explanation with the graphs, and then show the relationship that is existing between graphs.